Hi everyone, I'm Maria, the student of Executive MBA IPMI International Business School. I'm excited to share insight about corporate finance, a great topic I explore under the guidance of the inspiring professor Roy Sandler. Let's start with the objective of a corporate finance course. The main goal is to get the students' problem-solving skill in finance from the point of view of management internal and the investors external. By the end of this course, you should be able to first, explain important financial management decisions and interlinked among them. Second, apply financial management decision-making tools in analyzing financial decision problems. Third, explore and evaluate opportunities to create financial value to funds and investors. Fourth, utilize logic for corporate finance to include participants' decisions in other business-related situations. 5. Demonstrate ability to discuss in a structured way hot issue that immerse in the business or finance media. So, what exactly is financial management? It's all about optimal orchestration of internal and external financial resources towards significant and sustainable value creation. The goals of financial management can be broken down into four main categories. 1. Basic objective: profit maximization and wealth maximization. 2. Operational objectives: timely availability of requisite finances, most effective utilization of finances, safety of investments, growth of enterprise. 3. Social objectives: timely payment of interest, payment of reasonable dividends, timely payment of wages, fair settlement with suppliers, timely payment of users, maintaining relation with financiers. 4. Research objectives: researching into new and greater sources of financing. Now, let's talk about what we need to manage in corporate finance. Capital structure, working capital management, asset structure, revenue management, cost management, cash flow management, growth management, and risk management. Understanding these concepts is crucial. Here are some important finance ideas you need to know. Risk-return trade-off, time value of money, cash is king, incremental cash flows, cost of competitive markets, efficient capital markets, agency problems, taxes bias business decisions, always is not equal, ethical behavior. So, what are the goals of a fund? They typically revolve around 1. Maximize profits. 2. Maximize shareholders' wealth. 3. Agency problems. Now, let's discuss the principal agent problem. This involves conflict of interest, asymmetric info, moral hazard. And the solution to principal agent problem is make managers' compensation reflect share prices, stock options, fire managers who do not perform well, take over, good corporate governance or GCG. GCG consists of transparency, accountability, responsibility, independency, and fairness. Let's move to the four cornerstones of corporate finance by Kinsey and O. 1. Core of value principle. Value is driven by returns on capital and growth and cash flows. 2. Conservation of value principle. You can create value by rearranging claims on cash flows. 3. Expectations treadmill principle. The more investors expect of your share price, the better you must perform to keep up. 4. Best owner principle. A business's value depends upon its owner's capabilities. And here are the 5 business essentials by Professor Rangcharan. 1. Cash. 2. Profit margin. 3. Velocity. 4. Growth. 5. Customer focus. Now, let's look at some practical application of the type value of money. Mortgage and car loan payments, life insurance, personal financial planning, time deposit, contract values, damages in court cases, investment values, capital budgeting, company value. The law of secondary is simply a way to estimate how long an investment will take to double at a fixed annual rate of return, and calculate with the formula secondary divided by interest. Moving on to capital budgeting, which is the planning process for investment in long-term assets. Decision-making criteria in capital budgeting is accept or reject a long-term investment proposal. Capital budgeting concept consists of estimate expected future cash flows, evaluate the project based on capital budgeting evaluation criteria, decide whether or which project is good or bad. 2 or more projects can be mutual, exclusive, and independent. Remember, we have 3 types of cash flows: initial outlay, operating cash flows, and terminal cash flow. There are 4 capital budgeting methods. Payback period. How many years does it take to cover the initial investment? Witnesses this method is not considered time value of money, required rate of return, or cash flow from the project. The other 3 methods are net present value, profitability index, internal rate of return. All 3 methods above consider all cash flow, time value of money, and required rate of return. Let's continue to analysis of securities and portfolio investment. Fundamental analysis consists of company analysis, industry analysis, domestic and global economic analysis. Intrinsic value versus market price. Intrinsic value to calculate by investor. Basically, it is discounted future cash flow. Market price is consensus value by market participants. And the decisions is intrinsic value more than market price by intrinsic value less than market price, sell or short sell, and intrinsic value same as market price, quote, favorite pricing. Understanding financial segment is essential. We will look at the balance sheet, income statement, and cash flow statement. Financial statement analysis involves cash flow analysis consists of profitability, liquidity, activity, leverage, and market ratio. Healthy or not healthy. Using natural level, quality of numbers, historical trend, getting better or worse, industry benchmark, above or below average, decomposition by 2-point analysis. Cash flow analysis represents an attempt to standardize financial information in order to facilitate meaningful comparison over time and big informs. Liquidity ratios used to measure the ability of a fund to meet its short-term financial obligations. Efficiency ratios provide basis of assessing how effectively the fund is using its resources to generate sales. Leverage ratios used to measure the extent to which amount unmultiplied funds have been used to finance the fund's assets. Profitability ratios measures the overall effectiveness of the fund's management. Let's move to capital structure and corporate structure. Let's kick things off this capital structure. This refers to the compositions of long-term funding resources for a company, which includes debt and preferred shareholder equity. Capital structure theory by Multipliani and Dillard. Assumptions: no transaction costs, no taxes, everyone has safe information, same lending and borrowing rates for everyone, debt is riskless, debt doesn't affect operation. Flag like Montipianilla wrote an important paper in 1958, in which they proved that with tax deductibility of interest payments, the optimal capital structure is 100% debt. Let's break down the process of financial distress. It typically goes like this: early impairment, deterioration of performance, cash flow problems, failure, default, insolvency, bankruptcy. What happens in financial distress? When a company faces financial distress, several parts lie ahead: financial restructuring, legal bankruptcy, reorganize and emerge, merge with another firm, liquidation. Outcome of financial distress: turnaround opportunity, operation restructuring, asset restructuring, financial restructuring, private workout, file for legal bankruptcy, permanent problem, private liquidation, file for legal bankruptcy. So fighting transforming business, the key is to stop the leading, financial restructuring, temporary pivoting, strategic realigning, redefining core business, new ways of doing business. Next up is restructuring corporate structure. Here are some crucial areas to focus on. Capital structure, lower debt to equity ratio, working capital management, permanent versus non-permanent current assets, choice of working capital financial, asset structure, reduction of fixed asset ratio, revenue management, higher portion of recurring revenue, cost management, lower fixed cost portion, cash flow management, focus on 5 principles of cash management, board management, focus on orderly and partnership growth, risk management, lower risk appetite. And we move to the next data, fraud risk management. Fraud risk management is another critical aspect. Occupational fraud and abuse, corruption, asset misappropriations, fraudulent statements. The fraud hexagon, it includes opportunity, need, character, competence, arrogance, and justification. Reason for occupational fraud: huge personal debt or losses, lifestyle beyond income capacity, over speculation in debt risk quick scheme, gambling, perceived unfair treatment by company, pressure from family certain group, alcohol or drug addiction, love affair within the same office. The red flags of fraud. Identifying the red flags of fraud is crucial. Look out for signs like interpretation, if absence from office, still doing his or her works by phone, what employee covers the whole process, frequent loss or missing documents, often complain, very often communicate by phone, too many external cases, conflict of interest, lifestyle beyond income capacity, often borrow money from colleagues, look very easy but low productivity. Fraud prevention. To combat fraud, you need robust prevention measures. Red is obvious that have to be followed if fraud event is suspected or discovered or identified. Train employees to increase alertness for fraud. Protective security, hardware and software. Create whistleblower mechanisms. Lead include ethics. Whistleblowing. Act of reporting misconduct to managers, executive, or other authorities with the power of corrective action. 4 types of incentives: physical, monetary, social, moral. And we'll learn about issue in finance from 4 movies: Boiler Room, Rogue Trader, Trading Places, and Other People's Money. And the last but not least, we study about dividend. Financial profitable capital investments. If we retain earnings for profitable investments, dividend yield will be zero, but the stock price will increase, resulting in higher capital gain. Paying dividends. If we pay dividends, stockholders receive an immediate cash reward for investing, but the capital gain will decrease, since this cash is not invested in the firm. Dividend policy really involves two decisions. How much of the firm's earnings should be distributed to shareholders as dividends? How much should be retained for capital investment? Is dividend policy important? Based on three viewpoints. Dividends are irrelevant. High dividends are best. Low dividends are best. Factors affecting dividend policy: funds liquidity, as dividend rates, earnings stability, debt obligations, investment opportunities, control policy, shareholders' expectation, past dividend risk, company's financial policy, impact of trade cycle, borrowing ability, legal restrictions, corporate taxation policy, government policy, divisible profit. All of that are overview about complex finance. We hope you'll find this information very well. Thank you for watching. Bye-bye.